How has the Fed's zero interest policy affected Berkshire Hathaway's various business segments? For example, has it helped or hurt their operations and profitability?
Well, it's helped. You know, interest rates are to asset prices, you know, sort of like gravity is to the apple. And when there are very low interest rates, there's a very small gravitational pull on asset prices. And we have seen that getting played out. I mean, people make different decisions when they can borrow money for practically nothing than they made back in 1981 and 2 when Volcker was trying to stem inflation and the government bond rates got up to 15%. So interest rates power everything in the economic universe, and they have some effect on the decisions we make. We borrowed the money on the Heinz purchase a lot cheaper than we could have borrowed it 10 or 15 years ago. So that does affect what people are willing to pay. So it's a huge factor, and of course, presumably it will change at some point. Although, as Charlie's pointed out, in Japan it hasn't changed for decades. So if you wanted to inflate asset prices, you know, bringing down interest rates and keeping them down. At first, nobody believed they'd stay down there very long. So it reflects the permanence that people feel will be attached to the lower rates. But when you get the 30-year bond down to 2.8%, you know, you're able to have transactions take place. It makes houses more attractive. I mean, it's been a very smart policy, but the unwind of it, you know, has got to be more difficult by far than buying. I mean, it's very easy if you're the Fed to buy $85 billion a month, and I don't know what would happen if they started trying to sell $85 billion. Now, when you've got reserves there it'd certainly be a lot easier than if those reserves had already been deployed out into the real economy. Then you would really be tightening things up. But you know, this is like watching a good movie as far as I'm concerned, and because I do not know the end, and that's what makes for a good movie. So we will be back here next year, and I will, or maybe in 2 or 3 years, and I will tell you I told you so, and hope you have a bad memory. Charlie?
Well, I strongly suspect that interest rates aren't going to stay this low for hugely extended periods. But as I pointed out, practically everybody has been very surprised by what's happened, because what's happened would have seemed impossible to practically all intelligent people not very long ago. At Berkshire, of course, we got this enormous float in the insurance business, and our incremental float, when we're carrying huge amounts of cash, is worth less than it was in the old days. And that, I suppose, should give some cheer to you people, because if that changes, we may get an advantage.
Yeah, we have 40, at the end of the first quarter, we had, whatever it was, 48 or maybe 9 billion or something like that in short-term securities. We're earning basically nothing on that. We never stretch for yield in terms of commercial paper that brings 10 basis points more than Treasury. Our money, we don't count on anybody else, so we keep it in Treasuries basically, and so we're earning nothing on that. So if we get back to an environment where short-term rates are 5% and we would still have the same amount, then that would be a couple $2 billion of annual earnings pre-tax that we don't have now. But of course, it would have lots of other effects in our business. We have benefited significantly, and the country has benefited significantly by what the Fed has done in the last few years. And if they can successfully pull off a reversal of this without getting a lot of surprises, we'll have all been a lot better off.